welcome to Smart Money. I'm Sonia Shenoy. Well, in the past 2 weeks, the equity markets have been hit by geopolitical tensions in Russia and Ukraine, with crude prices hitting 14-year highs. U.S. inflation has hit 40-year highs, and the U.S. Fed is all set to raise interest rates for the first time in 4 years. Amidst all of this, the Nifty has now corrected 15% from the top. So what do you do in a market like this? Today, we speak to two experts who've seen many such downtrending cycles, and more importantly, they stayed afloat. So let's gain some of that wisdom and try to learn the behavioral aspect of investing in equity markets during tough times. Joining me now is Kaustubh Berarpurkar, the Director of Fund Research at Morningstar Investment Advisor, and Gautam Duggad, who is the Head of Institutional Equity Research at Motilal Oswal Financial Services. I think between them, they have about maybe 3-4 decades of market experience, so it would be a good learning for us. Gentlemen, welcome to the show. Gautam, let me start with you. I had no clue while fixing the show that the two of you know each other. You know, you guys go way back in time. You are not only friends, but you all study together, and I am as well. So when markets fall, do you folks pick up the phone and call each other for advice? And how does it work? I mean, in a falling market, what's the best approach?
Hi, Sonia. Good afternoon. Yeah, I mean, we do go long way back. We had studied together. And yes, we do speak on and off. But I mean, the point that you raised, in a down market, down trading market, typically after a very ferocious bull run, some point of time you always, initially it takes a while to understand that the trend has changed or not. But if you are looking at things fundamentally, you would always remember that market always moves in cycles. And historically also, if you look at the data of last 2-3 decades, there have been multiple incidents of, big double-digit corrections for a variety of events, domestic or, global or geopolitical, politics. There are a variety of reasons always which drives the markets down. I think what has historically proven to be a good strategy during such times is to the process that one has, know one's temperament, and then follow it with discipline, irrespective of what is happening to the market, because over a period of time, markets will move up and down. What helps in compounding for a long term for your portfolio is your approach to investing and how rigorously and with discipline you stick to that approach. So some points of time, I mean, one of the best examples of that is demonstrated in the SIP flows actually. Coincidentally, we've seen over the last 2 or 3 years, the SIP flows and the SIP folios have gone up substantially in India. And that in a way shows you that the investors have kept the faith in equities through the thick and the thin. And that has helped a lot of investors in terms of beating the fixed income returns and also benefiting from the underlying corporate earnings growth that India has seen after a long time. So yes, it becomes volatile. It tests you. It tests your patience, because somehow historically one had always been told that equities give you quick returns. It's a get-rich-quick scheme. But once you spend certain amount of time in the market, you realize that you do make money, but with time, discipline, and patience.
So you realize that there's no get-rich-quick scheme, right? There's nothing like a free lunch in the markets, or for that matter in life. But it's interesting you point out about patience, because there are a lot of investors that entered this market in the peak of the lockdown. A lot of young investors who have perhaps not seen a bear market just yet. So just tell us, Gautam, how do you identify a downtrending, or how do you identify a bear market, and then how do you wade through it?
So Sonia, a technical definition of bear market, as technical analysts will tell you, is a correction of 20%. But in practical aspect, if you see of late, these market cycles have shrunk. Markets have fallen 20, 25, 30% in a quick succession and also rallied equally fast. The latest example is COVID. In Jan to March 20, that period of time when COVID was just about to, hit us, markets corrected very sharply in Feb and early part of March. And then once we started seeing a lot of cases hit India, casualties went out. Markets, on the other hand, rose, and it crossed the pre-COVID, lows or pre-COVID peaks very fast. So traditional definition of bear market sometimes becomes academic, especially in an environment where the world is interconnected and what happens globally impacts, multiple markets, multiple asset classes actually at the same time. So Russia-Ukraine conflict again is a very good example. while India is directly not involved in that conflict, we are getting hit because the commodity markets have felt the impact. We've seen impact in currency market as well. And globally things are moving in a direction. Flows have got hit. We have seen virtually $1 billion of selling for the first 4 or 5 days of March, and after seeing a $12 billion in January and February. So I would think that instead of spending too much time in deciding whether it's a bear market or a bull market, what will help investors over a period of time in compounding their wealth consistently is sticking to the process and discipline, as I mentioned, wherein you keep investing regularly and also take advantage of the volatility. The legendary investors have always said that volatility is your friend on the upside as well as on the downside. So if you have identified certain stocks which you wanted to buy, but you couldn't buy because of expensive or rich valuations in an uptrending market, the bear market or a downtrending market is giving you that opportunity to buy. However, you need to press the trigger at that point of time and do not get fearful, because what you've identified as a conviction idea, sometimes that conviction gets tested when the market falls 15-20% in a matter of few days.
Okay, got that. Let's get Kaustubh on board as well. Kaustubh, this market is down 15% from the highs that we saw in October, right? Can you tell us what are the historical returns over the years? Do things really change because of a war-like situation, or does it sort of iron out if you are a long-term investor? It doesn't really make a difference. I mean, what has history taught us?
Absolutely, Sonia. I think Gautam really laid the context very well in terms of really, stay invested in the process. And I think that's a very crucial message that needs to go to investors. And, the history, as you alluded to, shows us exactly that, right? There have been scenarios even worse than this, in the past. We've obviously lived through the GFC, where markets are down anywhere in excess of 50-60%. And there have been other periods in the last 20 years, about 8-10 times where the markets have actually fallen 50% or greater. So the whole point being that, what do you do when the markets are down? And what is history telling us? We know it's not a one-way ride in the market, but when we look at the longer-term returns, and clearly when we think about equity, it is a asset class that you would minimum want to keep money for at least 5 years, if not longer, ideally 10 years plus. When you look and slice and dice even the historical performance, for indices, what that shows you is that the longer you stretch a track record, when I say longer, we've done analysis looking at 1 year, 3 year, 5 year, 7 year, 10 year rolling returns. And what it shows you is that, the longer as you move from a 1 year rolling period to say a 3 year, or a 5 or a 10 year period, your range of returns reduces, which essentially means that there's greater predictability in the returns. But the more important point is, the probability of negative returns actually comes down very sharply. So, typically when I think about a 1 year context, 1/3 of the times, if you're invested, over the last 20-30 years, 1/3 of the times you will actually get a negative return over a 1 year context. But that very dramatically shrinks to just about 1% of an absolute aberration when I look at the data, where had you held for a 10-year period, you would have made negative returns on the portfolio. And the rolling average is, almost 13+%. So the moot point is that if you have the right investing horizon, you stick to your process, don't press an exit or a panic button. There is money to be made in the equity markets, but bear markets will come. You have to just stay invested, and kind of go through the ride. I mean, that's really the way I would think about it, the learnings that we've had from so many years of looking at the markets.
So Gautam, that's an interesting point that Kaustubh was making, right? You have to stay in it for the long term, and perhaps a long-term period would be, say, 5 years, 6 years, 8 years, and then perhaps you'll reap the kind of returns that you'd want to see for yourself. But what is the strategy for young investors who've entered into this market, say in March of 2020, when, we had hit that low, saw supernormal returns in the next 1.5 years, and now in the last couple of months have seen a lot of their returns getting wiped out? How do investors survive losses in their portfolios after seeing big gains?
Sonia, the best advantage and the biggest advantage actually that the young investors have is time. Timing in the market, as many people often, fret over, is not as important as spending time in the market. And that's an advantage that an youngster possesses. Somebody started working at the age of 24, 25. He has at least 20, 25 years of compounding ahead of him. somebody who started at 35 has lesser number of years, and therefore that is the biggest advantage that a young investor always has. Secondly, time is always a friend of good company, right? And it's an enemy of bad company. So if your stock selection, sector selection or fund selection is good, then time will take care of a lot of things as market moves on between up and down cycle. However, to answer your specific question, if somebody is entered in March 20 and has seen big amount of returns in the next 18 months and now is going through a bit of volatility, I think one has to learn to take such things in her own stride. Secondly, this also gives an opportunity to reassess your portfolio, whether something you bought, is fundamentally a sound company or not. This is typically a time, even when markets are rallying hard, that also should be utilized as a time to rebalance the portfolio. It's something you bought at a fair value with certain assumption of a fair value, and when the market is rallying and you think that the current price is far exceeding the fair value, I think there is no harm in trimming those positions. Secondly, whenever the thesis of the investment changes, then irrespective of whether it's a bear or a bull market, you should not hesitate to accept that mistake and move on, because over a course of time you will definitely make many mistakes in the markets. And such markets at their extremes allow you that chance to ruminate over those decisions and make timely corrections in the portfolio. So I think spending more time in the market, building a good portfolio which can compound for a long period of time is one of the best attributes that a young investor can use in an equity, especially in equity markets.
Okay, so some pearls of wisdom coming through from our experts. But folks, stay on. We need to take a short commercial break. Don't go anywhere. We'll be back in just a bit to tell you how to wade through these tumultuous times. Stay with us. Welcome back to Smart Money on CNBC TV18. We're talking about how to wade through a downtrending market, and I have with me Kaustubh Belarpurkar and Gautam Duggad. We're chatting about some behavioral trends on what one should be doing when you see losses in your portfolio. So Kaustubh, you've put out a lot of data for us. Just tell us, how does one really time this market? Do you buy when the market falls 15%? Do you wait for it to fall more? Do you raise your cash levels? What is the right approach when you look at sort of historical data?
Sure. So let me actually talk about a very interesting study that we've done, and that will address the question of should you time the market, or what should you do when the market's down, right? So a very simple study where we ran the last 10 years of market returns versus cash, and looked at the best months of performance of the market versus cash, and kind of looked at how many months would the investor not have been invested in those months, which would have resulted in the investor's portfolio actually underperforming the cash returns, right? The staggering part of that was that just 8 months out of those 120 months accounted for all the outperformance of the market versus cash, which basically means that you as an investor, if you were trying to time the market, not invested in the markets at all, and if you missed those good 8 months, you would have underperformed cash. That's staggering, right, over a 10-year period. But if you're already invested, which we've seen good trends of a lot of investors, already being invested, the first thing you should look to do is think about, there's got to be a focus towards asset allocation, and that's very important because, every investor will come with different risk profiles and different time horizons, and accordingly, his or her asset allocation would get decided. But, equity is obviously one of the more popular asset classes for long term, but, things like, stuff like gold or international equities or fixed income are things that shouldn't be forgotten because they add good diversification within their portfolio. Obviously, these levels would vary for different kinds of investors with different risk and time horizons, right? When you look at your own construct, and this can work both ways, right? So if you're sitting at the top of, the markets have run up very sharply, the one thing you would want to do is probably reduce equity allocation if it's gone beyond. I mean, just for an example, if you're an 80 equity, 20 fixed income portfolio investor, markets have run up, the equity allocation's gone up 90-odd%, you might want to bring it down to 80%. This could have happened to a lot of investors pre-COVID. They were sitting on high equity levels, market correct. On the other side, when there's a market correction and your market levels, your equity levels have gone below where you want to be at, it's a good time to add. And obviously the concern always is that I add today and it's going to keep falling tomorrow. SIPs, stagger it out is the best way to take care of, take that emotion out of investing, bring our equity levels back to, what we call the strategic allocation. At least markets get cheaper, you can probably again look to reallocate. So I think that's the move point you should be thinking about an investor. Markets correct, you keep adding, bringing back to strategic levels. That'll really help you over the long run.
Okay. Gautam, since this is sort of a situation that people don't see too many times in their life, right? A war-like situation. What has history taught us about how equities react to wars? I was going through a report which suggested that in the very near term, equity markets fall across the world. But in the medium term, there is absolutely no impact of a war on risky assets like equities. Is that a fair assumption?
I would tend to agree with that, Sonia. So it depends on the length of the war, actually, and what is the magnitude of the conflict. Right now, it seems like a localized conflict, and while the implications are quite severe on the commodity prices, as we have already seen, but it remains to be seen how long this can continue. So one thing which is always associated with the war is uncertainty. Equity markets, as we all know, hates uncertainty. Right, but volatility, uncertainty is, as I said in the beginning, is a friend of a long-term investor. And typically, if a war leads to bear market, and which is a very short and shallow bear market, it also allows you, the investor, the opportunity to buy good stocks. Basically, if the value of your pick, which is the stock that you identified through your homework, hasn't come down, but the price has come down, then that's the best time for the investors to go ahead and buy that, because price is what you pay and value is what you get. So this kind of events where markets correct sharply does help over a period of time in enhancing and basically enhancing the long-term compounded returns of your portfolio. As far as this specific situation is concerned, it's very difficult to say right now because things are still evolving. But like Kaustubh mentioned in his remarks, the best thing to do in such time is to basically stay invested, because if you are not staying invested and you happen to miss out on those 5 or 10% of the time, which basically provide sharp outperformance, then you are basically defeating the purpose of equity investing. So staying invested, identifying good quality stock, and then having the discipline to buy them when the opportunity offers it, I think is a fairly simple process to follow, but not an easy process to follow.
So you said, Gautam, that if the price falls, but the value of a company doesn't fall. But that's not the case right now, right? I mean, although prices are falling, the earnings are also getting hit quite a bit because of global inflation and the kind of commodity pressure. So what do you do at a time like this? If the company is good quality and earnings are getting hit right now, just because of this temporary situation, do you still buy into it?
Absolutely, Sonia. If you've identified a market leader with a humongous pricing power and which has been demonstrated over a period of time across decades, then higher input cost, episodes of higher commodity prices are always an opportunity to buy those stocks. And we have seen this play out so often in the last 20-25 years. Whenever crude prices go up, the users of those commodities always get impacted in the short term for a quarter or two when their margins come down. But if they have a pricing power, they have the leadership, and they have the brand franchise, which has been, which has been demonstrated over a period of time, I think that company will exercise the pricing power and take care of the inflation. However, it may happen that after you bought, the stock is down another 10 or 15%. So your horizon becomes very important in such times. So one of the ways of dealing with a downtrading market, as you said in the beginning, is you extend the time horizon of your investment and reduce the risk. Of course, you can't end up buying companies which do not have pricing power or categories where there is a fragmented competition which doesn't allow you to exercise that pricing power. So what you buy is very important in such times. And the company that you're going to buy has to have a good demonstrated track record of having navigated through this multiple cycles of commodity inflation and deflations. So that's why I said, the value can come down in the short term because your EPS may get cut in FY23 or things like that. But if the long-term, sustainable advantage of that company has not been hurt, then I think such drawdowns are a godsend opportunity to invest.
Okay, well, Kaustubh and Gautam, it was a pleasure speaking to both of you. Thank you so much for joining us on Smart Money. And thank you for, telling our young investors how to approach this markets, because I guess this is the first time that a lot of investors, new investors, would have seen some kind of bear trend or downtrend, something that we haven't seen in a while. So thanks a lot for helping us wade through that. With that, it is curtains down on this edition of Smart Money. Thanks so much for watching. Keep writing into us. We love getting feedback from you. Until we meet again, stay safe.